This show is part of OnePlace, a daily network of focused briefings across the stories people follow most.
Welcome to the Roundup. We are tracking a massive SpaceX deal, Tesla's hardware limitations, and the global economic ripples of the Iran war. Let's get into the details of today's top stories.
SpaceX partners with Cursor to dominate AI coding.
Iran war costs drive UK service sector inflation.
Older Tesla models won't achieve full autonomous driving.
Oil prices hold high as Iran seizes ships.
Musk delays Optimus reveal to prevent competitor copying.
Tesla reports mixed earnings amid an AI pivot.
Spirit Airlines faces potential government bailout after collapse.
Airlines brace for the biggest fuel shock ever.
Starting with SpaceX. SpaceX has just announced a massive partnership with the AI coding startup Cursor, a move that many industry experts are calling a game changer in the race for artificial intelligence dominance. This deal isn't just a simple collaboration. It gives Cursor direct access to SpaceX's immense computing resources, specifically the Colossus training supercomputer. The goal is to create the world's most advanced coding and knowledge work AI. What makes this particularly striking is the financial structure of the deal. SpaceX has secured the right to acquire Cursor later this year for a staggering $60 billion. Alternatively, they can pay $10 million for the specific work produced during this partnership. This move signals that Elon Musk is aggressively positioning his companies to leapfrog rivals like OpenAI and Anthropic by integrating specialized coding capabilities directly into his hardware infrastructure.
The tech community is buzzing about the strategic logic here. Analysts like Alex Finn have pointed out that while Musk's xAI has struggled to keep up with coding-specific products, Cursor has a fantastic product, but lacks the independent infrastructure to scale without relying on competitors like Anthropic or OpenAI. By joining forces, Cursor gets the massive compute power it needs to build its own proprietary models, while SpaceX gains a critical software edge. There are even reports of a potential three-way partnership involving the French AI firm Mistral. This synergy is seen as a way to solve the vibe coding hurdle, where tools are currently too dependent on third-party APIs. For Musk, this is another step in a very busy year that included the acquisition of xAI and a confidential IPO filing for SpaceX, all aimed at winning the AI war.
Next to the UK, the economic fallout from the war in Iran is hitting the United Kingdom hard, with economists warning of a significant spike in service sector cost inflation. While the most recent data showed a slight drop in the annual deficit, with borrowing at £12.6 billion in March, experts believe this is the calm before the storm. The conflict in the Middle East has exposed how vulnerable the UK economy remains to geopolitical shocks. Investment strategists are noting that while rigid fiscal rules have helped manage borrowing so far, the rising costs of energy and debt interest are quickly eating away at the fiscal headroom established by Chancellor Rachel Reeves. As gilt yields become elevated once again, the government may be forced to rely on tax increases to keep public finances steady, which could further stifle national economic growth.
The outlook for the current financial year is increasingly grim. Analysts from Capital Economics and RSM UK are predicting that the energy price shock will cause borrowing to overshoot forecasts by as much as £29 billion in the coming years. Thomas Pugh from RSM UK pointed out that while the full-year borrowing for the previous cycle was in line with expectations, the war in Iran means the situation will deteriorate sharply. This limits the government's ability to offer any meaningful bailouts to households or businesses if energy prices continue to climb. With borrowing costs set to rise quickly from here, the brief window of good news regarding the UK's public finances appears to be closing. The pressure is now on the Treasury to navigate a landscape of high inflation and shrinking options for fiscal intervention.
Now to Tesla's hardware. Tesla owners who were promised that their vehicles would eventually become fully autonomous are facing a disappointing reality check. During the recent first quarter earnings call, Elon Musk admitted that cars equipped with Hardware 3, or HW3, will not be able to achieve unsupervised full self-driving. This affects a massive number of vehicles produced roughly between 2019 and 2023. Musk explained that the internal computer in these models simply lacks the memory bandwidth required for the task, possessing only 1/8 of the capability found in the newer Hardware 4. This is a significant reversal from years of marketing claims, including a 2016 blog post stating that all Tesla vehicles being produced at that time would have the necessary hardware for full autonomy. For many loyal customers, the dream of an over-the-air update turning their car into a robotaxi has effectively ended.
To address this, Musk suggested that Hardware 3 users might be offered a discounted trade-in to upgrade to a newer vehicle or a new computer system. However, it's not just a simple software swap. The cameras on these older cars would also need to be replaced to work with the Hardware 4 system. Musk acknowledged the logistical nightmare this presents, noting that Tesla would likely need to set up small dedicated factories in major metropolitan areas to handle these upgrades, because existing service centers are already too busy. This hardware limitation is a major hurdle for Musk's vision of a global fleet of autonomous cars. It raises serious questions about the long-term value of older Teslas and the company's ability to fulfill its past promises to consumers who bought into the autonomy narrative years ago.
Moving to oil markets. Oil prices are remaining stubbornly high, holding above the $100 a barrel mark as tensions in the Strait of Hormuz escalate. Iran recently seized 2 container ships attempting to exit the Gulf, a move that has tightened its grip on a waterway responsible for a fifth of the world's daily oil and liquefied natural gas supplies. While Brent crude saw a very slight dip to around $101, it remains at levels not seen in weeks. The situation is further complicated by deadlocked peace talks between Iran and the United States. Despite a ceasefire extension requested by mediators, the U.S. Navy maintains its blockade of Iranian ports. Iranian officials have made it clear that a full ceasefire is only on the table if that blockade is lifted, leaving the energy market in a state of high anxiety.
Interestingly, while energy risks are mounting, global equity markets have been surprisingly resilient. The S&P 500 and Nasdaq recently hit record highs, driven by a strong start to the corporate earnings season. In Asia, Japan's Nikkei crossed the 60,000-point threshold for the first time, and markets in South Korea and Taiwan also reached new peaks. However, financial strategists are warning that this disconnect between rising market valuations and increasing geopolitical risks might be unsustainable. The U.S. military has already begun intercepting Iranian-flagged tankers and redirecting them away from key Asian shipping lanes, which could lead to further supply disruptions. As long as the blockade and the seizures continue, the volatility in oil prices will likely persist, eventually testing the optimism currently seen in the stock market as energy costs filter through the global economy.
Back to Tesla's robots. Elon Musk is playing it close to the vest when it comes to Tesla's humanoid robot Optimus. During the Q1 earnings call, Musk revealed that the company is hesitant to show off the latest version, Optimus V3, because they fear competitors will perform frame-by-frame analyses to copy their technology. Musk stated that there is significant value in keeping the new tech hidden until it is much closer to actual production. Currently, Tesla is preparing 2 dedicated factory lines for the robot, one in Fremont, California, and another at the Gigafactory in Austin, Texas. The Fremont line is expected to produce 1 million units annually, while the Texas facility has a long-term goal of 10 million robots per year. Musk has called Optimus the biggest product ever for Tesla, emphasizing its potential to transform the company's future beyond just being an automaker.
Despite the grand ambitions, Musk did try to inject some reality into the timeline. He noted that dismantling the existing Model S and Model X production lines in Fremont to make room for Optimus will take several months. He described the process of retooling a factory at this scale as an insanely fast undertaking if they can manage it within a 4-month window. While testing is ramping up and Musk hopes Optimus can perform tasks outside of Tesla's own factories by next year, the Texas production line isn't expected to be fully operational until the summer of 2027. This shift toward robotics has already led to the discontinuation of the Model S and Model X to prioritize space. It's a high-stakes pivot that relies on Tesla maintaining a technological lead over unnamed copycat rivals in the humanoid robot space.
Regarding Tesla's earnings, Tesla's first-quarter earnings report presented a mixed bag for investors, reflecting the company's difficult transition from a pure automaker to an AI and robotics powerhouse. While Tesla beat earnings expectations with 41 cents per share, it missed revenue targets, bringing in $22.39 billion against an estimated $22.6 billion. The stock initially saw a small bump but quickly erased those gains after Musk announced plans for massive capital expenditure this year. The core car business is under significant pressure, facing fierce competition from Chinese manufacturers and some consumer backlash over Musk's political involvements. Despite these headwinds, the company claimed that vehicle demand is rebounding, though the stock has still limped along, falling about 11% so far this year, as it lags behind other mega-cap tech rivals.
During the call, Musk was uncharacteristically subdued, but remained firm in his belief that robotics and self-driving products will eventually dominate the world. He faced tough questions from investors about the specific timing of these innovations. Tesla is currently rolling out its self-driving cars in several Texas cities and has plans to expand robotaxis into Florida and Las Vegas. However, the amazing abundance mission Musk frequently cites requires a level of execution that the market is currently skeptical of. The pivot to AI is a clear attempt to justify Tesla's high valuation. But with the core automotive margins being squeezed, the pressure is on for Optimus and the robotaxi fleet to move from the prototype stage to meaningful revenue generators. For now, the company remains in a state of flux, betting everything on a future of autonomous machines.
Now to Spirit Airlines. Spirit Airlines is currently a case study in how quickly a major carrier can unravel. Once of the most profitable airlines in the United States, Spirit is now in advanced discussions with the Trump administration for a massive federal bailout. The proposed deal could include a loan of up to $500 million and a potential government equity stake. This follows a disastrous 4-year period marked by 2 bankruptcy filings, thousands of employee furloughs, and multiple failed merger attempts. The decline began in earnest back in late 2021 when a surge in pandemic cases and staffing issues forced the airline to scale back its recovery plans. By early 2022, Spirit reported significant losses, excluding federal aid, and began looking for a lifeline through a merger with Frontier Airlines, which ultimately failed to stabilize the company's long-term prospects.
The timeline of Spirit's collapse shows a series of missed opportunities and external shocks. Despite repeatedly telling investors and employees that there was a clear path forward, the airline found itself trapped in a cycle of operational failures and mounting debt. The failed merger with Frontier was just one of several attempts to find a partner to help absorb its losses. Now, with private options exhausted, the only remaining path seems to run directly through the U.S. Treasury. This potential bailout highlights the extreme fragility of the low-cost carrier model. In a post-pandemic world, where fuel costs and labor disputes have become increasingly volatile. If the government does take an equity stake, it would mark a significant intervention in the domestic aviation market, reflecting just how dire Spirit's financial situation has become in recent months.
Finally, fuel shocks. The global airline industry is bracing for what could be the most severe fuel shock in history. Jet fuel prices have doubled in just 8 weeks, a catastrophic development for an industry where fuel typically accounts for 20 to 30% of total operating costs. While executives are hoping for a short, sharp shock, similar to those seen in the past, the current crisis is different. Supply routes are at significant risk due to the war in Iran, and there are fewer policy tools available to mitigate the impact. The head of the International Energy Agency has already labeled this the biggest energy crisis ever recorded. Parts of Europe are warned they could run short of fuel within weeks, and the situation in several Asian countries is described as even more desperate, threatening to ground flights regardless of the price.
As airline earnings season kicks off, executives are being grilled by analysts on how they plan to navigate the storm. History offers 5 different endings to previous fuel shocks, ranging from the 1973 crisis to more recent spikes, but none perfectly match the current geopolitical landscape. The combination of high prices and a looming supply crunch is a double-edged sword that could test passenger demand in ways the industry hasn't seen in decades. Unlike previous crises where airlines could hedge their fuel costs or rely on government intervention, the scale of the current disruption in the Middle East leaves very little room for error. If supply lines in the Strait of Hormuz remain blocked, the aviation sector may be forced into a period of radical downsizing or significant fare increases that could permanently alter global travel patterns.
That's our look at the stories shaping the day. Thanks for joining us for this briefing. We'll be back tomorrow with more updates on the news that matters most to you.
For more daily briefings, follow this show on your favorite platform. Stay informed, and we will see you next time.